Hello everyone and welcome to This Week in the Markets. In this week's video, we'll take a look at US equities and the bullish and bearish case that we can make for it. We'll also give an indication of what we're watching out for that could set the trend in the coming month. And we'll do that right after this disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So US equities had quite a quiet trading week so far, as many traders are still away on their last week of summer vacation. From the 3 months since the beginning of June, the S&P 500 has rallied from 1280 to 1410 as of the close yesterday. This is a gain of over 10% and is quite a significant gain for the index, and is one that rarely continues without some kind of consolidation. Last week, the index tried to break above a significant resistance at 1420, but failed and fell back to 1400. A false breakout adds to the risk of a correction, as it reminds traders of the resistance level, and it also encourages profit taking. On top of that, the rally last month was accompanied by very low trading volumes. To be sure, August had always been a month of low volumes because traders are usually off on summer vacation in the US. But still, the fact remains that we don't really trust significant market moves that occur on low volumes, only because when the majority of traders return to actively trade the market, the previous movement could quickly reverse. Another factor that supports a bearish case is the rate at which sentiments have jumped up over the last few months, especially on many different risky asset classes. According to the AAI sentiment survey, bullish sentiments are now at the highest level since April, and that is just 1 month after sentiments fell to a 2-year low. Although bullish sentiments are not at extreme level yet, but the rate of the rebounds does make us wary of a short-term pullback, as traders might begin to take profit from the previous run. In terms of news, we will be watching closely the Jackson Hole meeting, as there has been much speculation and expectations of quantitative easing, and that if Bernanke does not deliver what the market expects on Friday, it could be the catalyst that ignites a wave of profit taking. If we take a look at the Bloomberg Financial Condition Index, which monitors the level of stress in the US financial market, and is probably the extent of the Fed's reach in terms of what they can achieve with monetary policies. During the last 3 years, when Fed Bernanke implemented the 2 rounds of quantitative easing and Operation Twist, the index was still at negative levels. However, now the index is at positive levels and is actually near the highest level in the last 5 years. With this, we can argue that even if the Fed does engage in more quantitative easing, it will probably have very limited impact on the economy, and so the Fed may decide not to actually engage in any more quantitative easing program. However, while we do not really believe the Fed will implement any significant easing measures, we could not entirely discount the risk either, given that the Fed seems to be very eager to take on more actions, and very soon, as the minutes suggest. The Federal Reserve in US has a dual mandate of employment and price stability, and employment, as we know, have been very weak in the US in the past few months. For that reason, the Fed could still engage in more easing measures in hope to spur the jobs market, even though it might threaten price stability. For the bullish argument, we also have the ECB plan to buy sovereign bonds of indebted nations to help bring down bond yields and stabilize the crisis in Europe. Mario Draghi has repeatedly suggested that the ECB will take on aggressive actions to support the euro. He reiterated these warnings yesterday as he said that exceptional measures are needed to stabilize the financial markets. The European crisis had dampened the mood of the market over the last 3 years, and any positive developments there would be bullish for US equities. Moreover, we also have seen economic data coming out quite positively in US in the second half of the year. This week we saw a range of economic data from home sales, durable goods, and GDP data coming in better than expected. The Fed Beige Book, which was released yesterday, also reported a pickup in retail activities and that the economy continued to expand gradually in July. Nonetheless, most of the districts still reported that employment was holding steady or growing only slightly, which gives the Fed more room to accommodate the market if needed. Finally, the low trading volumes, while being a bearish factor, also could be a bullish factor if equities break out of a new high. The lack of participation in this rally means that most traders are probably still underinvested in equities. And if they return from the holidays next week to find equities at a new high and the Fed is implementing more monetary easing, it could spark a new wave of buying and equities could continue to rally after the breakout. So that's all our argument for both a bullish case and a bearish case for equities. We ourselves are leaning more towards the bearish case in the short term, as we suspect that Bernanke will probably disappoint during the Jackson Hole meeting. For the medium to long term, we think that US economic recovery is picking up momentum in the second half, and there will be more confidence in the market if and when the ECB steps in with its bond purchase program. So that's all from us this week. We'll have another update next week, and until then, on behalf of the Trading Pursuits team, wish you all a profitable trading.